Hi, in our last class, we discussed the concept of cost of capital, where we dissected the introduction to cost of capital, importance of cost of capital, how to compute the cost of individual source of capital, including cost of equity, cost of preference share, and then cost of debt. We went on to discuss the concept of weighted average cost of capital, where I mentioned that there are three categories of cost of capital. Number one is traditional weighted average cost of capital. Two, project-specific cost of capital. Then three, the weighted average cost of capital of the combined activities. So we concluded with the traditional weighted average cost of capital, where we had a practical illustrations after discussion around all the concepts. So today we are going to be discussing the project-specific cost of capital and the work of the combined activity. So what do you understand by project-specific cost of capital? The project-specific cost of capital is computed when a company is diversifying or where debt equity proportion of a company is expected to change as a result of undertaking a project. This is because the existing work of the company will not be suitable to appraise new investment opportunity, because every industry, every business has its own peculiar risk. So the existing weighted average cost of capital of the company will not be appropriate to undertake a new project when a company is diversifying, because a company will be moving from one industry to another industry. And every business or every industry has its own peculiarities. And that is why the existing work of the company will not be suitable to appraise a project. Therefore, when a company wants to diversify into a new industry, and there will be need for the company to undertake a project in that new industry. So what the company will need to do is to meet with the proxy company that are already operating in the new industry and borrow the beta of those proxy companies for the purpose of estimating the appropriate cost of capital that will be suitable to appraise the new investment opportunity. Okay, so that is basically what project-specific cost of capital is all about. I will take it again. So you are going to calculate project-specific cost of capital if it can be ascertained that the company is diversifying into a new industry, or the business or the debt equity proportion, okay, of the company is expected to change as a result of undertaking a project. The debt equity proportion is the percentage of equity and debts, okay, percentage of equity and debts as shown in the capital structure of a company. So once the proportion of equity and debt is going to change as a result of undertaking the project, then the existing work will not be suitable again to appraise a new project. So that is basically what project-specific cost of capital is all about. So let's talk about some definition of terms. Okay, let's talk about definitions of terms. Let me write it out. Definition of terms. Okay, number one, we are going to talk about business risk. Okay. Two, we are going to talk about financial risk. Then three, we are going to talk about beta value. Okay. Under the beta, we talk about asset beta. Okay. Asset beta. Then we talk about equity beta. Then finally, we are going to talk about proxy company. Okay, because these are some of the terminologies we are going to make use whenever we want to compute project-specific cost of capital. Therefore, what do you understand by business risk? The business risk is the risk associated with the industry where a company operates. Okay, business risk represent the risk associated with the industry where a company operates. It involves the variability in the cash flows. Okay, in the variability in the cash flows of the company or that the project will generate. All right. So the business risk is measured by asset beta. Okay. Then the second one is financial risk. Financial risk is the risk arising from debt financing. So when a company finances its operation with debt capital, the company will be exposed to financial risk. So if you can see any form of debts like bonds, debenture, loan note, or bank loan in the capital structure of a company or in the balance sheet of a company. It means that the company will be exposed to financial risk. Okay, because if the company is unable to pay the debt, of course, that may affect the ownership structure of the company. So, and that's why whenever you want to calculate a project-specific cost of capital, you need to ascertain if the proxy company has debt in its capital structure for the purpose of ungearing or regearing and all of that. Okay, so like I said, the financial risk is the risk arising from debt financing. Once you can see that a company has debt or the debt equity proportion will change as a result of undertaking the project, then again, that may result to financial risk. Then the third one, terminology we need to discuss is beta value. So beta measure risk associated with a project. So a project, there are two types of risk that can affect a project. One is the business risk, which measures the risk associated with the industry where a company operates. The second one is financial risk, which is the risk arising from debt financing. So there are basically two types of risk in relation to project specific. So we have asset beta. Okay, there are two types of beta. One is asset beta, then two is equity beta. What do you understand by asset beta? Asset betas measures only business risk. When you want to determine the risk that's that affects the industry where a company operates, then you are going to calculate asset beta, because like I said, asset beta measures only business risk, and you know business risk measures the risk associated with the industry where a company operates. So asset beta is also known as ungeared beta. Okay, ungeared beta. All right, the beta that does not have anything like financial risk. Then the second one is equity beta. Equity beta measures both business and financial risk, and it is always higher than the asset beta. So equity beta measures both business and financial risk, and is always higher than the asset beta because it involves the element of business and also financial risk. Okay. However, where a company is only financed with equity, equity beta and asset beta will be the same thing. Okay. And the last one is proxy beta. Okay, proxy beta or proxy, let's call it proxy company instead of proxy beta. Okay. Yeah, proxy company. A proxy company is a comparable company that operates in the industry where a company is moving to. All right. Say, for example, you have company XYZ PLC that is into communication business. This company is now diversifying into oil and gas. So as the company is moving to oil and gas, and there's a project for the company to undertake in the oil and gas, so the existing work of the company in the communication business cannot be used to go and appraise projects in the oil and gas. So what XYZ PLC will do is to borrow the beta of the proxy company, comparable company, okay, operating in the oil and gas for the purpose of estimating cost of capital that will be suitable to appraise the project in the oil and gas. So when you talk about proxy company, it simply means comparable company, the companies that have similar business risk, okay? Because it is assumed that both the main company and the proxy company have similar business risk, okay? So that is, these are all the terminologies that you need to get familiar with as far as calculating project-specific cost of capital is concerned. So let's talk about how do you estimate project-specific cost of capital. The project-specific cost of capital will be computed by carrying out the following procedures. There are 5 distinct procedures you are expected to carry out whenever you want to compute project-specific cost of capital. So let's take it one by one. Okay, steps involved in calculating project specific cost of capital. So like I said, there are 5 procedures. The first procedure is to identify the proxy beta. Identify the proxy beta. So like I mentioned the other time, the proxy company is a comparable company that operates in the industry where a company is moving to. So the new industry that this company is moving to, you need to get the beta, you need to borrow the beta of the comparable company that are already operating in the new industry. So once you can identify from the question the proxy company. So in a particular question, in an ideal question, you are going to be given the name of the main company. So when you see any other name that is different from the main company, that other name is the proxy company. At times, examiner may not give to you the name of the proxy company, but there will be information to show that, okay, they are talking about the proxy company. So the information of the proxy company will certainly be given to you. All right. But the most important thing is that after you have read the question from A to Z, then you should be able to identify the portion or the section of the question that talked about the proxy company. So just go straight to where you have information of the proxy, identify the proxy beta as given. Then step 2, now that you have identified the proxy beta, the next step you are going to do is to ungear the beta. Ungear. You ungear the beta in order to remove financial risk. Okay? To remove, first thing first, ungear the beta if geared. Okay, if geared to remove financial risk. Okay, so if the beta identified in step 1 is geared, then you need to remove the financial risk, because first thing first, you want to calculate asset beta, and you know asset beta measures only business risk. You want to remove the element of financial risk from the beta you identified in step 1. How would you know that the beta identified in step 1 has financial risk or is geared? Okay, how would you know that the beta you identified in step 1 is geared? Of course, the beta identified in step 1 will be geared if and only if the proxy company has debt in its capital structure. If in the balance sheet or the statement of financial position of the proxy company, you can see element of debt like bonds, debenture, loan note, or bank loan, then it means that the beta identified in step 1 is geared. If it is geared, then you need to ungear it. How do you ungear it? That's the formula I want to give to you. There are 2 different formulas that you can use to ungear the beta. Okay? The beta identified in step 1 will be ungeared as follows, depending as follows, using, okay, will be ungeared as follows using the formula. Using the formula given below, depending on whether debt beta is given or risk-free. So the formula that you are going to use, to ungear will depend on whether debt beta is risk-free or debt beta is given. So where the debt beta is risk-free, number A, where debt beta is risk-free, that is equal to 0. That is where debt beta is, let me write it, that is BD equal to 0. So where debt beta, if you are told in the question that debt beta is risk-free, then in that case, asset beta, denoted as BA, will be calculated as the beta equity of a gear multiplied by equity value over equity plus debt multiplied by 1 minus tax. Multiplied by 1 minus tax. This is the formula that you are going to use to ungear, where debt beta is assumed to be risk-free. Alternatively, we can also calculate the beta assets where debt beta is risk-free. You can calculate beta assets as the beta equity of a gear multiplied by 1 divided by 1 plus 1 minus tax, then debt equity proportion of the proxy company. So that is the formula to use to ungear where debt beta is risk-free. Then number B, where debt beta is given. So where debt beta is given, then you are going to use the extended formula. And the extended formula is calculated as beta assets multiplied by beta equity of a gear multiplied by equity value over equity value plus debt value 1 minus tax rate of the proxy company. Then plus debt beta multiplied by debt value multiplied by 1 minus tax over equity value plus debt value 1 minus tax. So this is the big or extended formula that you are going to use to compute asset beta whenever debt beta is given. But where debt beta is assumed to be risk-free, then you can use either of these. Whether you use this or you use this, you are going to get the same answer. So this is how to calculate asset beta. Then we move to step 3. Step 3 says you should regear. Step 3, regear. You regear to incorporate the financial risk of the main company. Of the main company. So the main company is the company that is diversifying into the new industry. So whenever you want to regear, in step 2, you have ungeared. So using both step 1 and step 2, you are expected to use the information of the proxy company. So as you are moving to step 3, step 4, and step 5, all along, so you are going to be using the information of the main company. The main company is the company that is diversifying, is the company that is undertaking the new project. Okay, so that is that. So for you to regear, so what you are trying to do is to incorporate the financial risk. Okay, I did not complete this. The financial risk of the main company. Okay, so you want to incorporate the financial risk of the main company. So the formula you are going to use will depend on whether, for this purpose, let me just put it down. For this purpose, the formula to use to ungear, sorry, to regear will depend on whether, there is debt beta or debt beta is risk-free. Okay, so we depend on whether there's debt beta or debt beta is risk-free. So number A, where debt beta is risk-free, where debt beta is risk-free. Okay, so where debt beta is risk-free, then the beta equity of a gear will be computed as beta asset in step 2, whatever beta you have calculated in step 2, then multiply by 1 plus 1 minus tax. Okay, then debt equity proportion of the main company. So this is the formula you are expected to use where debt beta is risk-free. Okay, so the debt equity proportion you are going to use in step 3 will be the debt equity proportion of the main company, which is the investing company. Then number B, where debt beta is given. So where debt beta is given, so you cannot use this formula to calculate. Okay, you can't use this formula to calculate beta equity of a gear. Rather, you are supposed to repeat the formula you have in step 2. Okay, so where debt beta is given, the formula below should be used. The formula below should be used to regear. Okay, what is the formula? Same formula you have up there, which is beta assets equal to beta equity of a gear. All right, then multiply by equity value divided by equity value plus debt value 1 minus tax. So in this case, it is whatever information you have for the main company is what you are going to put there. You have nothing to do with the proxy company again. So plus the debt beta of the main company multiplied by debt value multiplied by 1 minus tax. Tax of the main company divided by equity value plus debt value 1 minus tax. Okay, so this is the formula you are supposed to use to ungear. However, where the debt beta of, say for example, the debt beta of the proxy company is given, but you are not given the debt beta of the main company, then of course it is assumed that the main company does not have debt beta. That means debt beta is risk-free, but you are going to compute using the extended formula for the proxy company whenever you want to calculate the beta, the asset beta. Okay, so that's step 3. Let's move to step 4 now. In step 4, you are supposed to calculate cost of equity. Okay, let me shift this to the left. So step 4, calculate cost of equity. Okay, using CAPM, capital asset pricing model. Calculate cost of equity using capital asset pricing model. So in this case, cost of equity, that is CAPM, will be computed as the risk-free rate of return plus the beta of a gear computed in step 3, then multiply by market return minus the risk-free rate of return. At times, examiner may not give to you the market return, but you are going to be given the risk premium. So the difference between market return and the risk-free rate of return is what is called risk premium. So like I said, the difference between RM and the RF, let me put it down because of space. Okay, the difference between RM and the RF is called risk premium. Risk premium. Okay, so that's that. Then step 5. So you need to calculate the weighted average cost of capital, project specific cost of capital. So calculate project specific WACC. Okay, project specific WACC. The same formula that you are familiar with in calculating WACC. So WACC is denoted as KW, which is equal to equity value over equity plus debt. It is assumed that the company is financed with both equity and debt, nothing like preference share. So multiply by cost of equity plus debt value over equity plus debt, multiply by after tax cost of debt. Okay, so you multiply with 100%. So that is how to calculate project specific cost of capital. So these are the 5 formulas, 5 procedures that can be used to compute project specific cost of capital. The step 1 is to identify the proxy beta. Step 2, you ungear. Step 3, you regear. Step 4, you cap it. Then step 5, you work it. So those are the 5 procedures. You want to put the acronyms, so you can just put it there. Acronyms of the steps. Steps, acronyms. So P, U, R, C, W. Okay, proxy beta, ungear, regear, cap it, then you work it. So those are the 5 steps that you're supposed to carry out whenever you want to calculate project specific cost of capital. So at this point, let's have illustration. Okay, let's have illustration to demonstrate our learning so far. Okay, let's have this illustration. Kilimanjaro, okay, Kilimanjaro PLC produces domestic electric heaters. The company is considering diversifying into the production of freezers. Data on 4 listed companies in the freezer industry and for Kilimanjaro are shown below. So we are given information of 4 different freezer companies: Mississippi, Limpopo, Zambezi, then Nile. Kilimanjaro is the main company, while the remaining 4 companies are the proxy comparable companies. So the par value per ordinary share is 25 kobo for Mississippi and Zambezi, 50 kobo for Nile, and 1 naira for Limpopo and Kilimanjaro. The debt beta of the listed 4 freezer companies is estimated to be 0.4. Okay, so we have been given the debt beta of the proxy company. Corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the threshold B rate, which is currently 9% per year. Corporate taxes are payable at the rate of 35%. The market return is estimated to be 16% per year. Kilimanjaro does not expect its journey to change significantly if the company diversifies into the production of freezer. You are required to estimate what discount rate Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. So that is the question. You want to calculate appropriate cost of capital. You can see examiner did not tell you to calculate project specific cost of capital from the requirement, but it's very glaring because examiner has told you that this company is diversifying. Okay, examiner was emphasizing on the diversification program. So the company Kilimanjaro is diversifying into the production of freezer. So if that is the case, then you are supposed to calculate project specific cost of capital. So how do I calculate project specific cost of capital? Like I said, you have 5 procedures. So step 1, so let's solve the question straight without wasting time. Solution. The name of this company is Kilimanjaro. So Kilimanjaro PLC is the main company. So step 1 for calculating project specific cost of capital. So I can say calculating project specific cost of capital. So as a student, for you to be on point so that you know what you are looking for, you can write out just beside the title, you can write out the acronyms. Okay, you already know that you want to calculate project specific cost of capital. So you can just write proxy beta, you ungear, you regear, you cap it, then you work it. So these are the 5 procedures that you want to carry out. So let's pick it one by one. This is exam method. So step 1, there's no need for you to say identify the proxy beta. Simply say proxy beta. Okay, proxy beta. So I will then go to the question. I need to go and identify the proxy beta of the for freezer production. Okay, I'm looking for proxy beta of freezer production. When you look at the table given to us, examiner has given us equity, beta equity for all the companies, including Kilimanjaro. So all I need to do, Mississippi has different beta. Limpopo, Zambezi, and Nai, they have different beta. All I need to do is to add up all the beta and find the average. Therefore, I would then say the average beta of the proxy is equal to beta of Mississippi plus the beta of, what's the second one? Mississippi, Limpopo plus the beta of Zambezi plus the beta of Nai. There are 4 freezer companies. Therefore, I need to divide it by 4 to get the average beta. So, which is equal to Mississippi. The beta of Mississippi, equity beta of Mississippi is 1.1, 1.25. So 1.10 plus 1.25 plus Zambezi and Nile. Zambezi is 1.3, Nile is 1.05. 1.3, then plus 1.05. You add up everything, then you divide it by 4. Equal. Then I will then bring out my calculator to say 1.1 plus 1.25 plus 1.3 plus 1.05 equal. That's 4.7. So 4.7 divided by 4. This should give us what? Divided by 4 equal to 1.175. This is 1.175. Since the beta given in the question are in 2 decimal places, then I can say 1.18. So approximately 1.18 to be consistent with the way the betas are given in the question. So that's step 1. We have identified the proxy beta. Then step 2 says you should ungear the beta. Before you apply the step 2, you must confirm that the beta of 1.18 is geared. So if the beta of 1.18 is already ungeared, so I'm going to skip step 2 and move to step 3. Okay? So before I put down my formula, I need to check if this 1.18 is geared. How will I know that the 1.18 will be geared? So the proxy beta will be geared if the proxy company has debt in its capital structure. If I can see the element of debt like bonds, loan notes, debenture, or bank loan, then it means that the proxy beta of 1.18 is geared. So I will then go to the question in the balance sheet where you have finance by. Under finance by, I can see bank loans. So it means that the beta of 1.18 is geared. So since the beta of 1.18 is geared, so I need to ungear it to remove the financial risk. Okay, so I would then say ungear. Remember, from our acronyms, U is we have done with P. So now we want to do U, which is ungear. So we want to ungear now in order to remove the financial risk. Before I put down my formula, see, I want to calculate. To ungear, I need to calculate beta asset, which measures only business risk. So for me to put down my formula, I need to go back to the question. Okay, so I want to know whether the proxy company has debt beta or debt beta is assumed to be risk-free. So according to the question, when I was reading it, examiner I indicated BD. So you are told in the question that the debt beta of the listed 4 freezer companies is estimated to be 0.4. So all the proxy company has a debt beta of 0.4. In that case, I'm going to use the extended formula to compute my beta assets. Okay, therefore I would then say the beta equity of a gear multiplied by equity value of the proxy company divided by equity value plus the debt value multiplied by 1 minus the tax rate of the proxy company, okay, plus the debt beta multiplied by debt value into 1 minus tax divided by equity value plus the debt value multiplied by 1 minus tax of the proxy company. So you have to watch out. At times in a question, both the proxy company and the main company may have the same tax rates, but it is also possible that they are going to have different tax rates. So don't just assume that they are going to have the same tax rates. So you have to watch out, because whatever the information you are using in step 1 and step 2 must relate to the proxy company alone. Okay, so if that is the case, now that you know the formula that you want to use to ungear, so all I need to do is to slot in the variables that I have in the question. Therefore, the beta assets will then be equal to beta equity of a gear is 1.18 we identified in step 1 multiplied by, I need equity value of the proxy company and the debt value of the proxy company. So according to the question, I'll need to go and check that if I'm given the equity value and the debt value. In this question, examiner did not give us equity and debt value, so we need to go and compute it. How do I calculate equity value? You remember when we did traditional weighted average, when you calculated traditional weighted average cost of capital, I gave you the formula that you can use to calculate market value of equity and the market value of debt. So to calculate the market value of equity is simply number of shares multiplied by XDIV share price. Okay, multiplied by XDIV share price. Simply put, share price. Forget about XDIV or no XDIV. As far as project specific is concerned, we are not doing anything. You don't have anything to do with dividend. So forget about whether dividend is XDIV or CumDIV. Just use your market price per share or your share price. Okay, that's the way to go. So if that is the case, I want to calculate market value of equity. So I need to multiply number of shares with share price. So if I don't have number of shares, how do I calculate it? Number of shares is share capital divided by nominal price per share. Okay, multiplied by the share price. So in this question, I'm not given number of shares, because when you look at the balance sheet, so we are given share capital, that's ordinary shares. So we are given share capital, so I need to convert the share capital to number of shares. Then I need to multiply that with share price. Again, I'm not given share price in the question. How do I calculate my share price? I have information to calculate share price because I can see any per share in the question. I can also see price earning ratio in the question. So with that, I should be able to calculate my my share price. So let's go and do our working. Okay. Step 3 will be here. Step 4. All right. Then step 5. Let's say our working will come here. So this will be our working. Working number 1. We want to calculate market value of equity. So calculating market value of equity, denoted as E. So based on the formula I gave to you when we had traditional WACC, because had it been I have number of shares in this question, I would just say number of shares multiplied by share price. But I'm not given number of shares, I'm given share capital. Therefore, equity value will be equal to share capital divided by nominal price. The nominal price or nominal value per share, the nominal value is the same thing as par value or face value, then multiply by share price. Again, when you look at this question, I don't have share price. Examiner did not give to us the share price, but you know for sure that when you want to calculate in the question, you are given earning per share, you're also given price earning ratio. With that information, I should be able to calculate my share price, because if you want to calculate price earning ratio, for example, price earning ratio is calculated as share price divided by earning per share. So examiner has given to you the price earning ratio. You are given price earning ratio. You are also given earning per share. So you are looking for share price. Just cross multiplies to get the share price. Therefore, share price will be equal to price earning ratio multiplied by earning per share. That's what you need to do. That's what examiner has hidden in the question. So go and look for it. So to get my share price, I can then say that is my share price is price earning ratio multiplied by earning per share. So that's how we are going to get our number. So we are going to do for all the proxy company for Mississippi, market value of equity of Mississippi. So I will then go to the question, what is the share capital of Mississippi? The share capital of Mississippi is 4,000. Okay, the nominal price, the par value of Mississippi, we are told that the par value per ordinary share is 25 kobo for Mississippi and Zambezi. So 25 kobo is for Mississippi. So 4,000 divided by 25 kobo. Okay. Here is 4,000 divided by 0.25. So that will give the number of shares. Then multiply by share price. I don't know the share price. So let us work it out first. So I need to take the price earning ratio of Mississippi. Price earning ratio of Mississippi. Okay. Price earning ratio of Mississippi is 12. Earning per share of Mississippi is 25 kobo. So 12 multiplied by 0.25. 12 multiplied by 0.25. So here is 12 multiplied by 0.25 earning per share. So what do you have there? Bring out your calculator. 12 multiplied by 0.25. That's 3 naira. So multiply by 3 naira. This 4,000 naira. So figures are in thousands. So what do you have now? The total market value of equity will then be 3 multiplied by 4,000 divided by 0.25 equal to 48,000. Okay, that's 48,000. That's the market value of Mississippi. We'll do the same thing for Limpopo. Limpopo. Then let's go and identify the share capital of Limpopo. The share capital of Limpopo is 9,000. It's 9,000. So price earning ratio of Limpopo is 10. Any per share of Limpopo is 53.3. 10, 53.3. Okay. Here is 9,000 divided by, okay, then multiply by, I don't know yet. So here is 10 multiplied by 53.3 divided by 100. 53.3 divided by 100, that's 0.533. 0.533 multiplied by 10 equal, that's 5 naira 33 kobo. Here is 5 naira 33. Then what's the nominal price of Limpopo? The nominal price of Limpopo, I think, is 1 naira. Let's check. For 9 and 1 naira for Limpopo. So 1 naira is the nominal price. Okay. 1 naira is the nominal price. So here is 1 naira. Final answer. So this will give us multiply by 9,000 divided by 1. That's 47,970. Here is 47,970. Then Zambezi. So what's the share capital of Zambezi? From the question, the share capital of Zambezi is 3,500. Okay, that's the share capital of Zambezi, 3,500. Price earning ratio is 9 naira. Sorry, it's 9 times. Any per share is 38.1. Okay, then the par value of Zambezi is 25 kobo, because we are told that 25 kobo for Mississippi and Zambezi. 25 kobo for Mississippi and Zambezi. So that's it. 35 divided by 0.25. Okay. All right. 3,500 divided by 0.25 multiplied by market share price. I don't know the share price. This is 9 times multiplied by 3 naira 38.1, I think. 38.1 divided by 100, that's 3.81. 0.381 rather. So 38.1 divided, sorry, let me even confirm. Let me confirm the earning per share of Zambezi. Yes, 38.1 is 38.1. All right. So 38.1 divided by 100, that's 0.381. 0.381. So 0.381 multiplied by 9 equal 3.429. Okay, 3.429. Can just round it to 3.43. Okay, multiply by 35 divided by 0.25 equal, that's 48,006. Here is 48,006. The last one for the proxy company is Nile. So what's the share capital of Nile? The share capital of Nile is 5,300. Okay, share capital of Nile is 5,300. Any per share is 14. Sorry, any price earning ratio is 14. Any per share is 32.3. Okay, so then the par value of Nile is 50 kobo. All right, so 53 divided by 0.5. Okay, 53 divided by 0.50. All right, multiply by share price, I don't know. So let's calculate that. What's any per share of Nile? Any per share of Nile is 32.3. Then price earning ratio is 14. So 14 multiplied by 32.3. 32.3. So 14 multiplied by 32.3. So that's 0.323. Okay, let me confirm that. 32.3 divided by 100. Okay, then multiply by 14 equal to 4.522. So 4 naira and 52 kobo. 4 naira and 52 kobo multiplied by 5,300 equal divided by 0.5 equal. That's 47,933. Here is 47,933. So I need to add up all the market value of the proxy company, market value of equity. Okay, market value of equity of the proxy company. All right, so 47,933 plus 48,006 plus 47,970 plus 48,000 equal. That's 191,909. 191,909. So this is the total market value of equity of the proxy. So let's do our working ones and for all. Then we want to calculate market value of Kilimanjaro, because we are going to need it when we want to calculate the project specific work. So what's the share capital of Kilimanjaro? The share capital of Kilimanjaro is, okay, 4,000. Share capital of Kilimanjaro is 4,000. Then the nominal value of Kilimanjaro is 1 naira, because we are told that 1 naira for Limpopo and Kilimanjaro. So 4,000 divided by 1 naira. Then what's the any price earning ratio is 8. Any per share is 106. So 8,106. 8,106. 8,106. Okay. 8 multiplied by 106 divided by 100 will give us 1.06. So the share capital is 4,000 naira divided by 1 naira. So multiply by 8 multiplied by 1.06 equal. That's not correct. Let me do it again. 8 multiplied by 1.06 0.06. That's 8.48. Here is 8.48. So 8.48 multiplied by 4,000. That's 33,920. Here is 33,920. Okay, that's the total value of equity of the main company. All right, so if that is the case, so what's the value of the debt? What's the value of the debt? So in this case, value of the debt, let me create more space. Okay, the debt value. So working number 2, calculating debt value. D. So the debt value will be computed as nominal value. The nominal value is the balance sheet value multiplied by interest. Forget about X int price. So multiply by interest divided by 100 naira, because debt is quoted at 100 naira per unit. However, according to this question, we are given bank loan. Bank loan is non-traded debt, so you cannot have market value for not, since it is not tradable, so you cannot have market value for it. So since that is the case, then of course, being a bank loan, I will say the proxy companies have bank loans. Okay, therefore there will be no market value of debts. In this case, the bank loan of the proxy company will be added together. So the bank loan of Mississippi for Mississippi plus Limpopo plus Zambezi plus 9 will be added together. So I will then go back to the question, what's the bank loan of Mississippi? Okay, the bank loan of Mississippi is, this is the bank loan that we are looking for, 5,300. Because of time, let's add it up. So 5,300 plus 12,600 plus 18,200 plus 4,000. Okay, plus 4,000. So let's go down there and put it there. Since I have it, I will just press 0. So all right, bank loan is 5,300. Here is 5,300 plus 12,600 plus 18,200 plus 4,000. So this should give us equal 40,100. 40,100. You can see we cannot progress since, because of the fact that the information we are looking for is not given in the question. So we have to find a way of getting it, and that's the essence of all of this. So for the proxy company, the debt value is 4,100. The equity value is 191,909. So let's continue now with that step 2. Okay, this is where we stop. So E is the equity value. Equity value of the proxy company is 191,909 divided by 191,909. Okay, plus 1 minus tax. The tax rates of the proxy company, we are told that corporate taxes are payable at the rate of 35%. So this 35% is not segregated between the proxy company and the main company. So it is assumed that the two companies have the same tax rate of 35%. Okay, so they have the same tax rate of 35%. So 1 minus 0.35 will give us 0.65. Raised to power, debt value is 4100 multiplied by 4100 divided by 191,909. Okay, so this is for that, then plus, I hope the other side will be sufficient for us. So because we are given debt beta of the proxy company, so debt beta of 0.4, here is 0.4 divided by debt value of 4100 multiplied by 0.65, 1 minus tax, divided by 191,909 plus, okay, this will not be sufficient. Let me reduce the font size. That's too big. Okay, so the beta assets will be calculated as 1.18 multiplied by 191 equity value over equity value plus 1 minus tax 0.65 multiplied by debt value 4100 divided by equity value. Okay, sorry, it's a mistake. There's no equity value here. Yeah, 1 minus tax. D, debt value 1 minus tax. Debt value is 4100 multiplied by 0.65. Okay, then plus beta value, debt beta, which is 0.40 multiplied by debt value of 4100, 1 minus tax 0.65 divided by equity value of 191,909 plus debt value is 4100, 1 minus tax 0.65. Okay, that's it. So our beta asset will then be equal to, bring out the calculator to say, multiply by 0.65 plus 191,909 equal, that's 217,974. 217, let me put it down, 217,974. Okay, then 191,909 divided by 217,974. Okay, equal, then multiply by 1.18 equal, that's 1.04. Okay, here is 1.04 plus the other side. The other side is 4100 divided by 217,974. Okay, the denominator is 217,974 equal, then multiply by 0.4 equal, that's 0.07. Okay, here is 0.07. Therefore, the beta asset will then be equal to 1.04 plus 0.07 equal, that's 1.1. Here is 1.11. Okay, 1.11. So now that I have the beta asset, I need to regear, step 3. So I need to regear to incorporate the financial risk of Kilimanjaro. So whatever I'm going to do in step 3, step 4, and step 5, I need the information of the main company, which is Kilimanjaro. So in the question, you are not told, examiner did not tell us that Kilimanjaro has debt beta. So it means that debt beta is risk-free. So I would then say, since the debt beta of Kilimanjaro PLC is not given. It is assumed to be risk-free. Okay, it is assumed to be risk-free. Therefore, the beta equity of a gear will be computed as the beta assets multiplied by 1 plus 1 minus tax of Kilimanjaro multiplied by the debt equity proportion of Kilimanjaro. So the beta equity of a gear will then be equal to 1.11 multiplied by 1 plus tax rate is 35%, so we are accounting for 0.65 multiplied by the debt equity proportion multiplied by the debt equity proportion of Kilimanjaro. Debt value of Kilimanjaro, okay? The debt value of Kilimanjaro, bank loan of Kilimanjaro is 17,400. And then the equity value is 33,920, I think. Let me confirm. We calculated equity value to be, yes, 33,920 for Kilimanjaro. And debt value is 17,400. Okay. So here multiply by 17,400 divided by 33,920. Okay. Therefore, the beta equity of a gear will then be equal to, bring out the calculator, 17,400 divided by 33,920 equal, multiply by 0.65 equal, plus 1 equal, multiply by 1.11 equal, that's 1.48. Here is 1.48. So the beta equity of a gear is 1.48. Then step 4, I need to calculate capping. Calculating capital asset pricing model, denoted as KE. So KE will be computed as the risk-free rate of return plus the beta of a gear multiplied by market return minus the risk-free rate of return. Okay? KE will then be equal to the risk-free rate of return according to the question. Let's go back to the question. What's the risk-free rate of return? We are told that corporate debts may be assumed from this paragraph. Corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the treasury bill rate, which is currently 9% per year. So treasury bill rate is 9%. But KD, cost of debt, we are told that cost of debt, cost of borrowing is 0.5% above risk-free rate of return of 9. That means KD is 9.5%. So let's continue. 9% is the risk-free rate of return. So if risk-free rate of return is 9%, what's market return? The market return is estimated to be 16% per year. Okay. So here is 9, risk-free rate is 9 plus beta of 1.48. Market return is 16 minus risk-free rate of return of 9. So mathematically, cost of equity is equal to 16 minus 9 equal, multiplied by 1.48 equal, plus 9 equal, that's 19.36. Here is 19.36%. Finally, I need to calculate the project-specific WACC. Calculating project-specific WACC. Okay, so project specific work denoted as KW is calculated as equity value divided by equity plus debt multiplied by cost of equity plus debt value divided by equity plus debt, cost of debt, 1 minus tax. Okay, so WACC equal to equity value of Kilimanjaro. We calculated 33,920. The debt value, let's go and put it there. Total market value of Kilimanjaro. So total value of Kilimanjaro is equal to equity value plus debt. Equity is 33,920 plus debt of 17,400. So that should give us 33,920 plus 17,400. That's 51,320. That's 51,320. So that's the total value of Kilimanjaro, 51,320. So here is 51,320 multiplied by cost of equity of Kilimanjaro, which is 19.36, multiplied by 19.36% plus open a bracket. The debt value of Kilimanjaro is 17,400 divided by total value of 51,320 multiplied by cost of debt. According to the question, we are told that corporate debt is assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the threshold rate of return of 9%. So 0.5% plus 9 will give us 9.5. Okay, give us 9.5. So I would then say multiply by 9.5% multiplied by 1 minus tax, 0.65. Okay, so lest I forget, after this, another one. So just say note KD equal to 0.5% plus 9%, which is 9.5%. So that you know how we got that. It's 9.5%. Okay then, so mathematically, KW will then be equal to, bring out your calculator, 33920 divided by 51,320 equal, then multiply by 19.36 equal, that's 12.8. So this is 12.80% plus the other side. The other side is 17,400 divided by 51,320 equal, then multiply by 9.5 equal, multiply by 0.65 equal, that's 2.09. Here is 2.09%. So approximately, or add it up, 12.8 plus 2.09, that's 14.89. 14.89%. So the work is approximately 15%. So this project, this cost of capital of 15% will then be used to appraise the freezer production for Kilimanjaro. Examiner is asking you, estimate what discount rates Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. So in this case, I would then say Kilimanjaro should use, okay, so I will say Kilimanjaro PLC should use 15% cost of capital to appraise is proposed freezer production. Okay, that's it. That's it. So we are done with how to estimate project-specific cost of capital. So we are moving to weighted average cost of capital of the combined activities. Okay. So we are going to have the work of the combined activity in a separate video lecture. All right. So if that is the case, this will be the end of a project-specific cost of capital. Okay. Yeah. So that's it from me to you.